Ever wondered how inflation, taxes, and market fluctuations affect your personal finances? It's like playing a game of chess with your money. But instead of battling against an opponent across the board, you're up against the triple threat of inflation, taxes, and market fluctuations. Let's break down these complex terms. First up is inflation. Think of it as the invisible hand that gradually erodes your purchasing power. It's the general rise in prices over time, meaning your dollar today might not buy you as much tomorrow. Inflation is like a sneaky pickpocket, slowly but surely taking away the value of your money. Next, we have taxes. Taxes come in many forms, from income tax to sales tax. These are compulsory contributions to state revenue, levied by the government on workers' income and business profits, or added to the cost of some goods, services, and transactions. Imagine you're running a marathon, and taxes are the weights you carry. The more you earn, the heavier the weights. And finally, market fluctuations. The financial markets are like a roller coaster. One day you're up, the next, you're down. Market fluctuations refer to the variations in the price of financial instruments such as stocks or bonds over time. These fluctuations are driven by a myriad of factors, including economic indicators, investor sentiment, political instability, and major events. Understanding these three factors is like holding a compass in the world of personal finance. They determine not just where your money goes, but how much of it you keep and how much it can grow. And while we can't control these external factors, we can learn to navigate them. So why does it matter? Because every decision you make with your money, whether it's buying a home, investing in stocks, or even just saving for a rainy day, is affected by these forces. It's like the weather of your financial world. And just like you wouldn't step out without checking the weather, you shouldn't make financial decisions without understanding these factors. Now that we've laid the groundwork, let's delve into the real-life impact of these factors. Scene script. Imagine this. You've saved $10,000, but over time, the buying power of this money decreases. Why? Inflation. Inflation is a bit like a stealthy pickpocket. It's the rate at which the general level of prices for goods and services is rising, and subsequently, our purchasing power is falling. To put it simply, if you save $10,000 under your mattress today, a year from now, you wouldn't be able to buy the same amount of goods with that $10,000. Why? Because the cost of those goods has gone up. That's inflation at work. Let's delve into a case study to illustrate this point. Meet John. John is a diligent saver who managed to put aside $10,000 5 years ago. He decided to keep his savings in a safe at home. Fast forward to today, and John is ready to use his savings. But he finds that the same items he could buy 5 years ago now cost more. The price of a gallon of milk, a loaf of bread, even his favorite movie tickets. Everything has gone up. His $10,000 just doesn't stretch as far as it used to. This is the impact of inflation. It erodes the value of money over time. It's why financial advisors often recommend investing your money in assets that can potentially earn a return greater than the rate of inflation. Otherwise, you're essentially losing money. Inflation is a normal part of a healthy economy. However, high inflation can be harmful, making it harder for people to plan for the future. And for those on fixed incomes, like retirees, inflation can be particularly harsh as their income stays the same while the cost of living rises. Inflation is a silent force that can slowly chip away at your savings. It's a concept that's easy to overlook, especially when the economy is doing well. But understanding and planning for inflation is essential for anyone who wants to maintain their purchasing power and secure their financial future. Inflation can silently eat away at your savings if you're not careful. Let's see how taxes can do the same. You've just received your paycheck. But wait, why is it less than what you earned? Enter taxes. Think of John, a hard-working citizen who earns $50,000 annually. As his paychecks roll in, he notices that a portion of his earnings is deducted. This is due to income tax, a compulsory contribution to state revenue levied by the government on workers' income. Let's break down the impact of taxes on John's personal income. Suppose John belongs to the 22% tax bracket. This means that 22% of his income goes directly to Uncle Sam, leaving him with $39,000. But wait, there's more. John also has to pay state taxes. Let's say in John's state, an additional 5% is deducted. This leaves John with just about $37,000 of his original $50,000. What does this mean for John's ability to save or invest? With a significantly reduced income, John may find it harder to put money aside for saving or investing. This can impact his financial stability and growth in the long run. Now, consider the taxes on John's investments. If John decides to invest a portion of his income in stocks and makes a profit, he will be subjected to capital gains tax. The tax rate can vary depending on how long John holds onto his stocks. If he sells his stocks within a year, he could be taxed as much as his ordinary income tax rate. However, if he holds onto his stocks for more than a year, he could benefit from a lower tax rate, ranging from 0 to 20%. So, as you can see, taxes can significantly influence John's financial decisions and his ability to grow his wealth. Planning for taxes is an essential part of personal finance, and understanding how they work can help you make more informed decisions about your money. Taxes can take a significant chunk out of your income, leaving you with less to save or invest. Now let's explore the unpredictable world of market fluctuations. You've invested in stocks expecting a smooth ride to wealth, but suddenly the market crashes. What now? Imagine this. Let's call our individual John. John, like many of us, believed in the power of the stock market. He was convinced that his investments were his ticket to financial freedom. But as we know, the market isn't always a calm sea. It's more like a roller coaster full of ups and downs. John had invested heavily in a particular tech company. The company was thriving, the stocks were soaring, and everything was going according to plan. Then, out of nowhere, a new competitor emerged, and the tech company's stocks took a nosedive. This is what we call a market fluctuation. Market fluctuations are changes in the market's overall value, often caused by a host of factors. These could range from economic indicators, global events, shifts in investor sentiment, or even changes in political climate. In John's case, it was the emergence of a new competitor that shook his portfolio. The impact of these fluctuations can be significant. When the tech company's stock plummeted, so did the value of John's investment. His once promising road to wealth seemed to be crumbling beneath his feet. This is the harsh reality of investing in the stock market. It's not always smooth sailing, but here's the thing. Market fluctuations, while unnerving, are a normal part of the investment journey. They're not always assigned to jump ship. Sometimes, they might even present new opportunities. For John, if he had diversified his investments, the blow from the tech company's downfall could have been softened. If he had a better understanding of market fluctuations and their causes, he might have been better prepared to weather this storm. Investing in the stock market is not just about riding the waves, but understanding them. It's about making informed decisions, understanding the risks, and being prepared for the ups and downs. Market fluctuations can make or break your investment portfolio. It's crucial to understand and navigate these waves effectively. Inflation, taxes, and market fluctuations might seem intimidating, but understanding them is the first step towards handling them effectively. Let's quickly recap what we've learned. Inflation is a general increase in prices that erodes your purchasing power. It's like an invisible tax that chips away at your savings and investments. Taxes, on the other hand, are a more apparent financial burden. They're a necessary part of our societal structure, funding public goods and services. However, understanding how they work can help you find legal ways to reduce your tax liability. Then, there are market fluctuations. These ups and downs in the market can significantly impact your investments. But with a well-diversified portfolio and a long-term investment strategy, you can ride out these fluctuations. Understanding these three factors is crucial in managing your personal finance. It can help you make more informed decisions and protect your hard-earned wealth. Remember, knowledge is power, especially when it comes to personal finance. Stay informed, stay prepared. Now that we understand the basics, let's dig into some practical tips to help you navigate the waters of inflation, taxes, and market fluctuations. Firstly, to protect your savings from inflation, consider investing in assets that historically have offered a return greater than the inflation rate. These could include stocks, real estate, and certain types of bonds. Also, having a portion of your portfolio in inflation-protected securities can be a good strategy. Next, to legally reduce your tax burden, consider investing in tax-advantaged accounts like 401(k)s or IRAs. Don't forget about deductions and credits, like those for education expenses or energy-efficient home improvements. Consulting with a tax professional can help you uncover more opportunities. Lastly, building a diversified portfolio is your best defense against market fluctuations. This means spreading your investments across different asset classes, sectors, and geographic regions. Remember, it's not about timing the market, but time in the market that matters. With these practical tips, you can take control of your financial future. Remember, the key to successful financial management is staying informed and proactive. By understanding inflation, taxes, and market fluctuations, and by employing these strategies, you can protect and grow your hard-earned wealth. Wow, we've covered a lot of ground today, haven't we? From understanding the intricacies of inflation, the complexities of taxes, and the unpredictability of market fluctuations, to practical tips on how to navigate these financial waters. Let's do a quick recap. We've learned that protecting our savings from inflation can be done by investing in assets with returns greater than the inflation rate. We've discovered that tax burdens can be legally reduced by investing in tax-advantaged accounts and utilizing deductions and credits. And we've understood that building a diversified portfolio is our best defense against market fluctuations. But remember, this is just the beginning. The world of personal finance is ever-changing and full of opportunities for those willing to learn and adapt. So keep reading, keep learning, and keep staying informed. Remember, your financial future is in your hands. Stay proactive, and you'll be well on your way to financial success. Until next time, keep striving for financial freedom.